Recurring revenue is the goal for almost every integration firm owner I talk to. And for good reason. Install revenue is lumpy. It depends on the sales pipeline, the bid environment, the economy. Recurring revenue is supposed to be the floor, the income that is there every month, regardless of what the install side is doing. The problem is that not all recurring revenue is created equal. There is recurring revenue that compounds over time, adds value to the business, and eventually becomes the primary reason a buyer pays a premium when you go to sell. And there is recurring revenue that looks like stability on the P&L while quietly draining cash flow and building obligations you cannot profitably unwind. Today, I want to explain the difference, show you how to tell which one you have, and give you the specific things your contracts need to include to stay on the right side of that line. Let me start with the simplest way to think about this. Recurring revenue is an asset when the margin it generates today is equal to or better than the margin it generated when you signed the contract. That happens when the price covers fully loaded delivery cost, includes a real margin cushion, and has a mechanism to keep up with cost increases over time. Recurring revenue is a liability when the margin it generates today is lower than what it generated when the contract was signed. That happens when the contract was underpriced to begin with, when costs have increased and the contract price has not, or when the delivery burden has grown, more callbacks, aging equipment, more complex client needs, without a corresponding price adjustment. The insidious thing about the liability version is that it does not show up obviously on a cash flow statement until the situation is already serious. The revenue line looks stable. The problem is in the delivery cost, which is rising quietly in the background. By the time most integrators realize the service book is upside down, they have two bad options: have difficult repricing conversations with every client simultaneously, or continue delivering services at below market rates indefinitely. Healthy recurring revenue is not complicated. It requires three things to be true at the time of signing and to remain true over the life of the contract. The first is full cost coverage. The contract price needs to cover every dollar it costs to deliver the service, not just the tech's hourly rate. Fully loaded, meaning the tech's wages plus benefits, plus payroll tax, plus their share of vehicle cost, insurance, tool depreciation, and overhead allocation. For most integration firms, that fully loaded hourly rate is somewhere between $65 and $95 per hour, depending on geography and benefit structure, even for technicians billing out at $40 to $50 gross. If your service contracts were priced using the tech's hourly wage instead of their fully loaded cost, every one of those contracts is underpriced from day one. The second is a minimum gross margin. After fully loaded delivery cost, the contract needs to generate at least 40% gross margin. Below 40%, you are assuming too much risk for too little return. Service work is inherently variable. Equipment fails, callbacks happen, client expectations expand over time. The margin cushion is there to absorb that variability without turning a profitable account into a money-losing one. Some integrators argue that 40% is too high for service contracts in their market. My response is always the same. If the market will not support 40% gross margin on service work, the market is telling you that the service is not worth delivering at the price it will accept. That is a business model problem, not a pricing problem. The third is an escalation clause. This is the one most integrators are missing. An escalation clause is a provision written into the contract at signing, not negotiated at renewal, that allows the contract price to increase annually by a defined percentage, typically 3% of 5%. Without it, every renewal is a repricing negotiation you are having from a position of weakness. The client has been paying the same amount for 2 or 3 years and considers that the baseline. Any increase feels like a change. With an escalation clause already written into the original agreement, the increase is not a change. It is a contractual obligation the client already agreed to. The compound effect of a 3% annual escalation on a $500 per month service agreement over 5 years is meaningful. The year 5 payment is $580 per month versus the original $500. On a 50-account service book, that is an additional $4,200 per month in revenue generated by language in the original contract, not by sales activity. If you have active service agreements, I want to give you a simple audit you can run this week. Pull every active agreement. For each one, answer 4 questions. Question 1. What does it cost to fully deliver this contract per month? Include tech time at fully loaded cost, parts and materials, any subcontractor costs, and a reasonable overhead allocation. Question 2. What is the gross margin after that fully loaded cost? Take the monthly contract price, subtract the fully loaded delivery cost, and divide by the contract price. That number is your realized margin on that contract. Question 3. Does the contract have an escalation clause? If not, when did you last adjust the price? Question 4. Has the delivery burden changed since the contract was signed? Is the equipment older? Are callbacks more frequent? Has the scope of what the client expects changed? If you cannot answer question 1 for every contract, your service book is unmanaged. You are not running recurring revenue. You are running a collection of promises with unknown economics. What most integrators find when they run this audit for the first time: between 20% and 40% of their contracts are generating less than 20% gross margin. Some are generating negative margin. The integrator is spending more to deliver the service than the contract pays. That is not a small problem. On a service book generating $50,000 per month in revenue, if 30% of those contracts are at sub 20% margin and should be at 40%, the revenue is the same, but the annual gross profit impact is north of $72,000. If the audit reveals underpriced contracts, you have 3 options. Option 1 is to reprice at renewal. Write the new pricing and escalation clause into the renewal agreement and present it as a standard update. This is the cleanest approach and the one least likely to create friction if the price increase is reasonable and clearly communicated in advance. Option 2 is to add the escalation clause at the next renewal, even if you do not raise the base price immediately. Get the mechanism in place so that future increases are contractual rather than negotiated. This is the minimum acceptable outcome for every contract that renews going forward. Option 3, for contracts that are significantly underwater, is to have a direct conversation with the client about the cost to deliver the service at current rates and make a business decision about whether the relationship is worth subsidizing. What you should not do is continue renewing underpriced contracts without escalation clauses while adding new ones on top. That is how service books become impossible to unwind: volume of obligation without margin to support it.